Tonight, I'm going to share with you how to build a financial pathway for long-term dental success. And to give you some background, I'm in my 35th or fourth year of practice or so. And over the years, I've purchased numerous practices that I've merged into others. I've also owned at any one time 3 different dental practices. But just because I started 30 something years ago, the struggle for financial freedom was no different than it was today. Yes, dental school was less expensive, but the dollar was less expensive. But I was fortunate that a colleague of mine's father, who was an endodontist, George Feldman, he was also a dental financial planner. And he sat us down early on and gave us some advice how to save for the future, some of which that I'll share today, and it still holds true today. What I'm also going to share for those that are interested is how I semi-exited my practices and how you can do that as well. Because building a financial pathway has a start and an end. And the path is very important, but you also have a vision, need to have a vision on where you're going to go. So I think, first of all, it's very important to understand I am a dentist. I'm a dentist that does read the Wall Street Journal every day, that has read the Wall Street Journal for many years, that has been very much in tune with my financial pathway. But I am not a financial advisor. So the financial advice I'm sharing with you has worked for me and several of my friends, but please consult a financial advisor for expert advice with anything I'm going to share with you. In other words, don't hold me responsible, although it's worked for me. I think one of the things that we lay as the groundwork is if you fail to plan, you're planning to fail. Time becomes your enemy. It creeps up on us very, very quickly. And the reality is, when it comes to saving, there's never a good time to save. There's always going to be that extra expense. There's always going to be a roof that went bad in the house, or a private school maybe for a child, or a camp, or an expense you weren't expecting. And that's why it's critically important that you are vigilant and diligent in your savings. It has to be consistent, and you must make the plan early in order to maximize your savings. Here's just an example. If you saved $1,000 per month starting at the age of 30, you will have amassed by the age of 65 close to $800,000 in savings. Yet if you waited till the age of 40 but did the same exact thing, your money is going to be basically half, $460,000 in savings. So one of the things that George taught me early on was, you may not have a lot of money. That's okay. If it's $25 a month or $50 a month or $25 a week or $50 a week or whatever that number is, start early and increase that saving as you go along. And I followed that path throughout my entire career. I started early. So for instance, our first grandson was born last year. I opened an account for my first grandson, as did my son. But I already opened an account as a newborn. Now, if I just contribute to that a little bit of money, forget $1,000 a month, $100 a month, $200 a month, that newborn will have millions of dollars by the time he's 65 years old. So the power of time is in your favor if you choose to do it as early as possible. But we have some financial realities. Average dental school debt today is $305,000, and that's a very conservative number. I looked it up today. NYU today, on average, is about $150,000 a year, plus, plus, plus. The University of Buffalo, I'm a New Yorker, is a state school. It's $90,000 a year, plus, plus, plus. So that number is the published number, but I would say it's a low number for dental school debt. 39% of dentists have debt over $300,000. Many have debt from college. And the median income for dentists still sits at only about $175,000. And most dentists cannot retire living the same lifestyle as they did while they were working. So how do you get around all this? How do you save money if you get out of school and you're in debt? We'll talk about that. The stressors put upon us, why we have trouble saving, dental school debt, practice purchase. I want to buy a practice. I want to own my own. Most people don't have the flexible money to purchase that. They're going to take an additional loan to do that. That means possibly a college loan, a dental school loan, and a practice purchase loan. Now tack on to that a home loan or a home mortgage. And things like medical insurance, schooling for children. It might be private school, college, or grad school. You still have to live. You want to go on a family vacation. You got to put a little bit of money for day to day, but you got day-to-day spending. That's your living expenses, your food, your electric, your gas. All these things are the stressors that stop us for saving for the future. So we have to navigate this and figure out how we can possibly do this. The question becomes, is lifestyle balance even possible today? So I think one of the differences generationally, and I'm 63, and I'll say I'm a young 63, is I'm not so sure that I had the ideal lifestyle balance. What do I mean by that? I missed some back to school nights. I missed some parent teachers conferences. Why? Because I was working. Some people would say to me, today, you can't miss that. You don't have lifestyle balance. I worked Saturday mornings for many, many years. But I did coach my kids in every single sport. And I was home for a lot of dinners. And we still were able to save and go on vacation. So my lifestyle balance when I was younger is very different than what many of the younger dentists want for lifestyle balance today. And I will be the first to say it's very hard. And I'm going to use this term very broadly because it means different to different people. It's very hard to get rich doing dentistry, rich financially, and have a perfect lifestyle balance. I'm not saying it's impossible. It's just very, very difficult to do that. Something has to give. Either you're going to give up a little bit on your family and home life, a little, or you may give up a little bit on your practice, and something is going to give in certain ways. But here's some basic rules to start this program off. I think everybody should live well, but live below your means. Most importantly, I would say, and this should have been on top, take care of your personal and mental health. Too often I read on Facebook these days that a dentist committed suicide or someone's in depression. And I will tell you very often, financial pressure plays a big role in disrupting mental health. Financial pressure can put on family pressure, and it's a big disruptor of mental health. And I would tell you, if you're worried about your mental health, speak to someone, reach out to me. My phone number will be at the end. Feel free to Instagram me at Vino Dentino. Reach out to someone, let someone talk to you. Take care of your family. And then really something you have to understand, and many younger dentists don't get this, but older guys like me too, work hard while you can, because dentistry is hard on the body, on your neck, on your hips, on everything else, on your back. It's tough on your body. So work hard while you can and make it. And then even if you can't, or if you think you can't, find a way to save. Find a way to put something away. Even when you think you can't. One rule of thumb is, before you pay any bills, put something away in a savings vehicle. You likely won't miss it at the end of the day, if it's a nominal amount. Where you're going to save and how you're going to save, here we go. So you have to understand some basics of savings. First of all, you have to understand yourself. What is your risk profile? Are you willing to put money into stocks and be able to stomach the stock market in its ups and downs? Right now, the last number of years, we've been in a bull market. So everybody, including myself, looks like a genius. You pick stocks and overall they go up. But the reality is that's not the way the stock market's been. It has highs and lows and peaks and valleys. Over time, does it go up? Yes, it does. But you have to know your risk profile. You also have to know, what are you saving for? Is it short term or is it long term? Are you saving for a house and you don't want to lose any money? Or are you saving for your son or daughter's college and they're 1 year old, and you know over time that market's going to go up and you can put it into funds or stocks or so on and so forth. For many people, you want to have some sort of a multifaceted approach, some sort of an approach that allows you for short term and allows you for long term. What types of savings vehicles are out there? And this is not the only list. This is a short list. Bank accounts. So many people feel comfortable putting their money in a bank account. They don't have to think about it. They don't have to worry about it. It's local. They have ATMs, and banks have been the baseline of saving for people in this country forever. What you have to realize, especially with the bigger banks, is that you're getting very, very low interest in that account. So while you're having security, you're getting extremely low interest. So Chase today could be 0.1 or 0.2%. And online banks and other banks, you might get 2%, 2.5%, but you're not getting 4%, 5%, or 10% like the market might give you if you're going to be in the stock market. Then you have something called certificate of deposits. These are vehicles where you can lock up your money for a period of time, 3 months, 6 months, a year, maybe longer, 3 years. And by locking it up, meaning you cannot touch that money, you are getting a higher interest rate. You can't lose anything in that CD, as they call it. But if you're extremely conservative and you feel comfortable with your money just in the banks, and you don't need your money in a short period of time, you can put your money in CDs and maybe get 3.5%, 3%, possibly 4%, depending on the bank, and depending on how long you're willing to lock up the money for. Typically, the longer you lock up the money, the higher the interest. What many people do that like investing in CDs, and it's not a vehicle that I typically choose, but they will rotate the time period. So they will put a small amount of money in 3 months, another small amount of money in 6 months, another amount of money in 12 months, and so on and so forth. So as things come up, money becomes open, and they can either change the vehicle they're investing in, or take the money out, or use that money for something else. Then you have individual stocks. Ideally, you want to do this with a broker. You do not want to pick your own stocks unless you're really, really adept in picking stocks. You can sit and start doing your own research, reading on the internet, but I would tell you to leave that to a professional. A lot of people try to skim today, and they go online to Schwab or whatnot, or E-Trade, and it's fine. But I always like to have my money with a broker, Morgan Stanley type broker, because you get a lot of benefit there. You're getting advice from a professional. You get other benefits that a brokerage house will give you. And when your money is not in the stock market, it could be in the money market. And the money market is basically like a bank account at a brokerage house. And that money market will pay you a higher interest rate than you will get in the bank. So for instance, the money I have at Morgan Stanley today in the money market is paying me at 4%. No risk. It's a bank account. Why do I keep some money there? Because the idea of diversifying and having some stocks and some bonds and a variety of vehicles like money market, when it's paying 4%, makes a lot of sense. Another way to invest is putting things in mutual funds. A mutual fund is an aggregate of stocks or bonds, depending on the fund, or commodities that is run by a professional. And what it allows you to do, instead of picking individual stocks, you can pick, for instance, a tech mutual fund, and you're diversified in that fund through 20, 30, 40, 50, whatever the number of stocks that mutual fund purchases. So some of those stocks individually may go up or down, but collectively, if more go up, that mutual fund will go up. You can also invest in bonds, and there's all types of bonds. And bonds typically are for people who have, I would say, more wealth later on in life. It's a good way of diversifying. Typically, you'll get, depending on the time, 4% tax-free. I just bought a bond for 5% tax-free. You can find them. This, again, you want to do with a broker, and you want to make sure bonds, if you're buying a bond, it's going to be what we call AAA or AA rated, meaning those bonds are fairly secure. You can buy bonds that are rated less, double B, double C, and you'll get more interest. But that's a bond that may go bad on you, and you may get interest. And for instance, that particular bond can go defunct. So I would not suggest that. And then, of course, you can invest in gold, whether it be in a gold fund or silver, a gold fund or silver fund, or you could actually buy gold. Now, why would you buy gold? Well, the reality is gold in the last, let's talk it, 5 years, is up 86%. That if you bought a gold bar 5 years ago in 2020 for $2,000 an ounce, gold today sits at $3,600 an ounce. So you have a great appreciation with gold. You can actually buy gold bars, gold coins, any of those things, and put them in your safe at home or put them in a safe deposit and just hold them. One of my friends runs a gold trading company called Franklin Mills. They have great stuff. And I spoke to him last week, and he obviously knows the business really well. And he believes in the next few years, gold, which sits today at 3,600 plus an ounce, is going to hit almost $5,000 an ounce. Do you know that for sure? No, but it's another way to invest. What can you do with gold? The reality is gold is cash. If I have a gold coin, a $3,000 gold coin, I could walk into a jewelry store, any store, and someone will let me, most people will let me use that as cash. So financial advisors are great. Private financial advisors will put together a plan for you, individualized based on your needs, and take a fee for their services. They may work for themselves, a small company, or a very large brokerage house. Make sure to vet out a financial advisor and make sure to interview a few. How would you know? Ask some friends, ask some people that have done well financially and ask them where their money is. And you'll get a good idea where to put your money, or at least who to interview. So the S&P, the Standard & Poor's, or an S&P fund is the simplest and cheapest way to save long term. Why? Because you set it and forget it. There are many companies like Vanguard that has a Standard & Poor fund. The S&P is a stock market index that tracks the stock performance of 500 leading companies listed on the stock exchange. It's one of the most commonly followed equity indices and includes about 80% of the total market cap of the U.S. public companies. The S&P on average, over the last zillion years, grows at about 10% a year. So for instance, 30 years ago, when I sat down with George Feldman, Michael Feldman, my friend was an endodontist, and a few other people, George said, I'm going to give you the dummy's guide to saving. Open up a Vanguard S&P index fund and just add money there whenever you can. Be consistent and add money, and you will slowly become rich. The crazy thing is, I can't remember how many times, but I can tell you, I've said this hundreds of times, how George's simple advice allowed me to accumulate money even in times when I didn't have money. Because I started putting money in at $50 a month, and then $50 every 2 weeks, and then $50 every week, and then 200 or 100 a week or 200 a week, and so on and so forth. And many companies have S&P funds. The reason Vanguard is, it's what we call a no-load fund. You're not really paying, or you're paying virtually nothing to be part of that. So that's the simplest way to save. If you say, I don't want to know from the market, I don't want to know anything, the S&P funds are a great way to save. You will have some volatility. You will have some years it's up 20%, and some years it's down 15 to 20%. But overall, the curve is directly up. And this is the historical chart. I know that it's a little bit fuzzy, but if you look from 1960 to 2020 alone, the curve goes straight up. And if I look at where the Vanguard Index Fund, which is the Admiral Fund today, once again, looking from 2020 till April of 24, you see the dips and the valleys. But what you see is it just goes up and up and up and up. But that's savings for us. People often ask us, how do we save for our kids? If I wanted to save for my kids, how would I go about and save for my kids? So when I first started saving for my children, today's most common saving vehicle for education, the 529 plan, was not even available. So all my kids' money went into what we call a uniform gift to minor account, a UGMA account. Now, it still holds true today. You can put money in a UGMA account, and I just did that for my grandson. So why one and why not the other? So there are a couple of things I think that are very important. Number one, the 529 plans, if you put money away, for the most part, can only be used for education. Any levels of education today, but it can only be used for education. Whereas a UGMA account can be used for any spending you want. The UGMA account goes over when the child becomes 18, it belongs to the child. The 529 plan is still controlled by the owner. Now, the differences are in a UGMA account, when that child gets control or takes money out, it is taxed at what the tax bracket would be for the child. The 529 plan gets to grow tax-free. So, and with a UGMA account, if you have a lot of money, you can put more away, whereas the 529 plan, you have capped amounts. So there's not a right or a wrong here, and this is where I would say you need to speak to your financial advisor and say, hey, here's what I want to save for my children for. For instance, some children have money put away by their grandparents. So the father and mother may not have to save for college. College is already paid for. So there you may want to put away, if you want to do, in a UGMA account. So that becomes very specific. And this is where I would say have your financial advisor really tell you what to do. So, and what you have to also understand is that state laws will vary on 529 plans and UGMA accounts. So you really depend, what I have in New York will be very different than what someone has in Florida or someone has in Texas. So once again, you want to reach out to a financial advisor and ask them how to handle that. So probably the more common place to save today for children is the 529 plan. The 529 plan can be opened by anyone, but usually it's parents or grandparents. So what's nice about 529 is the money grows tax deferred until it's withdrawn. So as it grows, you're not paying any tax on it. So you could start with a little bit amount of money and end up with $200,000 20 years later for college, and you're not taxed on that until it's withdrawn. And if you use that money for qualified education expenses, the withdrawals aren't subject to either state or federal taxes. So, but the weird thing is only 30% of Americans actually take advantage of this. A lot of people still don't know about it. And this is where a financial advisor can really, really advise you on your savings. This is where I tell you, don't try to do it on your own. Have someone give you the advice. So I say that, but I don't want you to be ignorant. You may have a broker that say, I think you should buy this stock today. Read about the stock, learn about the stock. There's so many places to learn and read today about the stock in the market and the market. I always read at least 1 or 2 pages of the Wall Street Journal every day. I typically will read Investors Business Daily once a week or twice a week. Just skim it to see what's going on. There's so many new companies coming out with AI I want to learn about. I just kind of want to know whether I'm going to invest in those companies. May or may not happen. I still want to understand and I want to know. So when it comes to investing and figuring out how and when you're going to go, just to recap, number one, risk tolerance. What is your risk tolerance in your investments? If you have no risk tolerance, you're going to put it into a bank account or a CD, and obviously you won't be able to make as much money long term, but your money will be 100% secure. If you have a higher risk tolerance, and I would say your savings future is extended, meaning I don't need the money for a house right now, I don't need the money for education, that's when you want to think about the stock market, mutual funds, working with a financial advisor. Most financial advisors today can go ahead and backtrack and say, okay, here's what you'll be able to save by the time you're 65. And then you have to consult with a financial advisor and say, well, I want to work till this age. I want to be able to have this much money every year to live on at this age. And they will be able to then back that into the equation and tell you how much you need to save in order to live like that. Remember my second slide. Most dentists can't live the same way in retirement as they could when they were working. So it's important to think about that and plan early. And then, of course, try and build your practice so you can create an exit. Because the next part of the equation is how to create that exit to so-called cap your financial pathway. It's okay to make the money and save the money going on, but your practice is your best asset, and you want to be able to sell that practice when it's all said and done. So what are things to consider when you get to the next phase? So I'm getting to my late 50s or early 50s, and now you kind of see, I call it, you have a toe out the back door. You're looking at the back end. Now you start thinking, did I save enough? I would say that almost every dentist, if you ask them in their 50s, early 50s, did you save enough? Most would say no. It's just the way it is. Very few will say, yes, I saved enough. Even though I was very good with my savings, if you asked me at 52 if I saved enough, I would have said no. You then have to figure out, okay, our prime earning years are probably 48 to 62. How much do I need to backfill my savings during these years in order to have that money that I need? You're going to make your primary amount of money in your late 40s, 50s, early 60s, as long as you stay healthy and you're okay. This is a time when your kids maybe are either finishing college, or you've saved for college, or they're out of college, and now it's time to save for you. Here's where you really got to say, how much do I have to sock away in order to live good when I'm done practicing? You also want to figure out, do you own a piece of real estate? Do you own your home? Do you own your building where your practice is? That's an asset. You want to be able to pay that off as fast as possible. So if you were not saving a lot over the years, but you were paying off your home or your building, that's saving. That is an asset. And then, the scary four-letter word is debt. Easy for me to say on the other end, if you're young, middle-aged, or old, get out of debt. Find ways to get out of debt as early as possible. That's what's going to allow you to be financially free. If you're in debt till you're 54 or 55, it's going to be hard for you to save deeply into retirement. So you need to get out of debt. But your best asset is your dental practice. Your dental office, your dental practice is your best asset. That's your money-making vehicle. I have a friend now who's didn't want to sell his practice. He's 78. He's still practicing. He loves what he does. He said, I could sell it and get some money out of it, but I'm still making money. So his best asset is a practice that's making money. Conversely, I could say selling your practice might become your best asset as well. At some point, you need to have a plan. So for me, I built 3 offices that I'll share with you. We were doing millions of dollars a year. And sometimes what happens is your blessing becomes your curse, because building a huge practice and not being able to sell it, or potentially not being able to sell it, is your biggest headache. Yes, you can make money and you can continue to make money, but at some point you want to be able to move that vehicle, move the practice. So I started thinking about it early on. I had associates in place. I decided I'm going to have to, little by little, compensate them for longevity, because we all know transition with associates is always a problem. But I realized also that these associates would never have the money to buy my practice. Forget if they're in debt or not. I've built a monstrosity, as many of you have. It's hard to sell that. So you start thinking, what's going to be your future? Do you have a child in the business? Do you have a son or a daughter, or maybe a relative in the business? Are you going to give your practice to that family member? Are you going to sell it to the family member? Will you give it to them and extract money from that business forever? These are all things to consider on, are you going to sell your practice? Can you put it on the market? Can you sell your practice to another dentist? Again, it's not easy, especially if you have a large practice, but it's doable. And then, of course, enters the world of DSOs, and we'll talk about DSOs. And I share with you that I did partner with the company, and I'll share with all of you who the company is. They're sponsoring tonight. It's MB2 and why. But I'll also explain to you the goods, the bads, and the uglies on what's happening in that space today, and how you can avoid a pitfall if you're thinking of entering that DSO space. So if you're going to sell your practice to an associate or another dentist, you're going to get somewhere between 50 to 90% of a year's gross. You can continue to squeeze the lemon and get as much money out of it as you can, like this dentist that I was telling you, who's 78 years old. But at some point, you're going to want to think of, how am I selling the practice? The prevalence of dental support or dental service organizations in dentistry today is tremendous. It's all over. And you hear so many horror stories about DSOs. You hear some good stories, but you hear a lot of horror stories with DSOs. And what I want to do in the next few minutes is kind of delineate for you a little bit what's out there, why I chose who I chose, and where the profession might be going a little bit. So if you look at the DSO landscape, general practice DSOs, you're looking at companies like Heartland Dental, MB2, Guardian, Dentiv, all these type of companies that are out there that primarily purchasing general dentists. They do purchase some specialty practices, but not all of them are doing well. There are a couple of winners, and there are a lot that are struggling and have struggled the last number of years. In the orthodontic space, you have companies like Smile Doctors, MyOrthos, things like that. They are gobbling up the ortho market. But I think today, again, Omar from MB2 may comment on this later, the ortho space is becoming very, very tricky for purchasing for these DSOs. The ortho space, as you know, is changing dramatically. You saw what happened with Align stock in the last few months. It got crushed. So I think that trickles down to the DSO space as well. And then you kind of look down the line, oral surgery, pedo, perio, endo, pros, all of them have kind of their own DSOs. It doesn't mean that a Heartland or an MB2 won't purchase a pediatric. As a matter of fact, MB2 just closed their biggest deal this week or a couple of days ago, and it was a huge pediatric office in upstate New York. A huge, huge, huge practice. There were multiple practices that had over a few hundred employees, so a huge monstrosity. So those things are out there. So let's talk about the names. What's a dental support or dental service organization? Companies like Heartland, the Aspen Group, Pacific Dental, they are a support organization that usually owns 100% of the practice and provides non-clinical support services. It could be branded or unbranded. So again, to translate that, They come into my office, Dr. Kaminer, we're going to give you X dollars and we're going to own your practice. You are an employee of us. We're going to tell you what to do to a certain extent. We may let go some employees to a certain extent. Most of these companies are purely about squeezing that lemon for as high profit as possible. Everybody wants to make money. Don't get me wrong. But these companies potentially could make change. Then you have the IDSOs, the Invisible Dental Support Organizations. They're a support organization in which affiliated dentists maintain some level of ownership or some level of input, and they receive silent support from that DSO partner. Smile Brands, DCA, GPS are all examples. Then you have what's called a dental partnership organization. And a DPO is an organization in which the company has purchased part of the practice from the dentist, and the dentist is a partner in that situation. Companies like MB2, Imagine are all examples of DPOs. I partnered with MB2 for this particular reason. I did not want a complete buyout. I wanted to have say in what I was doing. I didn't want someone to come in and change my staff, put their name on things, brand things. You walk into my offices, no one would have any idea that I partner with MB2, but I get complete support in the back office. HR, IT, legal, marketing, anything that I need, I got all in the back office. So it's a very unique model, and it's one of the reasons MB2 is killing it in the market, because when they purchased 55% of my practice, I was still a 45% partner. So very often I got asked, well, how does that work? Well, I get paid on production, just like any associate would. Plus, I got 45% of the profits at the end of every month. Now, very often what happens is that most dentists hesitate pulling the trigger because I'm going to make less money. And the answer is you might make less money, but you're getting paid a lot of money up front. The reality is, in my situation, I never made less money because they increased our profitability so much that I was basically making the same money owning 45% as I was making 100%. So those are the three main definitions that you should know. The other ones belong mostly to specialties and won't affect really a lot of you. But the reality is they have some similarities. Most of them have some form of capital backing, either private or institutional. They have some money coming from some investment bank. And they must grow inorganically to generate financial returns. And these companies do give non-clinical support at some level to practices. But they also differ. Their growth strategy differs. Their doctor ownership model differs. How the leadership team is composed differs. Their success rate differs. In the last number of years, 20 or 30 DSOs filed Chapter 11. So someone may throw a little bit of money at you and some stock at you, and if the company goes out of business, that stock becomes worthless. So they do have a bunch of differences. So the reality is, what is poised to happen? You know, the flight to quality will drive markets in dental sector for years to come. So you're going to see DSOs out there that are going to start to cherry pick the best of the best, because they've realized that the market is still tough today, especially a company like MB2. They want to partner with the right practice. You know, again, use me as an example. I got a good amount of money when I marketed. Some people might have said, all right, you go ahead and sign a contract for 3 years. I'm 3 years, and I could check out right now. And the last thing I want to do is check out. I love the partnership. I love what I do. I love my team. Nothing's changed. The last thing I want to do will check out. So these companies are going to, like MB2, are going to look for the cream of the crop, because they understand that my practice growth is tied to that company growth. So you're going to see, though, failures in the DSO space. You're going to see companies struggling and having issues. And what that's going to do is that's going to force companies like MB2 to really, really buy the cream of the crop. Not just because you have a big practice. I can tell you, because I've been involved in certain deals. I have friends that had $2.5 million practices that got turned down because there wasn't enough profitability in the practice. So all these things may come into play as we go forward. So if getting involved, it's really important to understand what it means to be a partner. What type of equity does a doctor get in a DSO transaction? Can associates have equity in DSO? And how is that DSO capitalized? Where do they get their money from? And this all varies company to company. So the difference is with MB2 is they're a partner. We're a partnership. What's good for me is good for them. What's good for them is good for me. And the reality is they want to keep Ron Kaminer happy. If Ron Kaminer is happy, Ron Kaminer continues to work. Ron Kaminer continues to run the office day to day. MB2 doesn't sit in my office. I run it. I'm the boots on the ground. So at the end of the day, that when you are a partner in a practice, you are actually owning some of your practice. You have a financial incentive to ensure practice success. If you're a shareholder in a DSO in the big company and you don't own your own practice, you don't really have day-to-day so-called caring because you have many other practices that could carry the weight if you want to, because you have a small ownership in that big parent company model. So you don't have any financial incentive to ensure practice success. And this is why a lot of these DSOs that have this parent company model are struggling or they're not so successful. So at the end of the day, you have to look, if you're going to approach a situation like this, not only as a seller, but also you're investing in this company. Do you want to get into bed with this company? Once I negotiated my deal, my decision was more mental based. Do I want to get involved with MB2 versus the money? It's not always about the money. If they would have given me $1 zillion and I didn't want to be with that company, it wasn't going to happen. So, and usually today, the deals are going to comprise what we call cash and stock. They're going to give you cash and some stock in the company, so you have a vested interest in the growth. They're going to evaluate your practice based on EBITDA, earnings before interest, taxes, depreciation, and amortization. The difference between EBITDA and net income, and I love this line from Charlie Munger. Anytime you see the word EBITDA, just substitute the word bullshit earnings. The reality is EBITDA is the true profitability in the practice. It is adding back anything that you're writing off from your business that has nothing to do with your business. It could be your medical insurance. It could be your car. It could be your phone. It could be your landscaper, whatever it would be. These are all going to be added back to determine EBITDA and figuring out the adjustments. The bullshit is not in the EBITDA, it's in the adjustments. So I always tell people, if you're going to speak with a DSO, they're not the IRS. Give them back every add back that you think, because you're going to be paid on that. That's how you're going to be paid. So again, to explain, discretionary income is the cash flow that's available to you after paying all your expenses and debt. It's collections minus overhead. But that, if you're paying personal expenses to your business or paying medical insurance, that overhead is a skewed number. Again, where EBITDA is, that's your true profit. So when a company looks at you, they're going to say, okay, you're showing a net of $200,000, but you have $40,000 in medical insurance you're paying for. You got $40,000 in a car. You have another $20,000 in your phone and your home insurance that you snuck through your practice. That's an extra $100,000 that is non-practice income that comes back to your pocket. Practices will pay you also on a valuation and some sort of a multiple. And that multiple will vary from company to company and practice to practice. That multiple may be able to be negotiated depending on how much they want you. Typically, the EBITDA is not a negotiated number, meaning the numbers are the numbers. Unless you find something that your accountant did not delineate for whoever is looking at your numbers, your EBITDA is your EBITDA. But if someone offers you a 4x multiple, you might be able to negotiate that to a 4.5x multiple. Doctors typically get paid a certain amount of money up front. They may get an incentive bonus, and they may have potential extra money if there's what we call a liquidity event. So there's a lot of different ways to make money in a DSO space, but almost every transaction is going to include a cash and equity component of the deal. And when you're looking at a deal, you want to look at the initial cash, the initial stock value, and expected future stock value, and future cash proceeds, earnouts, things like that. Very often today, a company will have a holdback. They want to make sure that your numbers are legit. So as long as you hit your number, they will hold some money back, but then give it to you once you hit a certain collection number or production number, depending on the company. Very often, and this is where some companies have struggled the last number of years, DSOs will have a liquidity event, or what they call a recap event. And this is when the investment bank that has funded that DSO wants or needs to move the asset. So they will sell that asset at a higher multiple, and the doctor owners can then sell a portion of their ownership at that same multiple. Nobody can guarantee a liquidity event. But if it happens, it's extra money that can be lucrative. So after I partnered 3 years ago, last year, there was a minority liquidity event that I was able to sell another 20% of my practice for additional money. They spoke about it day one, but they're the first to say they can't guarantee it. But it did happen. And the good companies, the strong companies, continue to have liquidity events. So why MB2? Why did I partner with MB2? MB2 has grown dramatically as a DPO. I am a partner. As of 23, they had 663 practices. Today, we got the email that they ticked their 800th practice with their biggest deal ever. They have over 800 now doctor partners. They have over 10,000 team members. They're represented in almost every state in the country. Their support services are incredible. Everything from marketing to HR to procurement, compliance. I thought I was in compliance before I joined MB2. Boy, was I wrong. I thought it was what I was called OSHA kosher. I was wrong. Everything now is perfect in my office. But they are able to support you everywhere, credentialing and business development and so on and so forth. You do the dentistry, you work with them to do everything else. But the most important thing is you're a partner. So you're free to make all your decisions, and no one's going to tell you what to do or how to do. Yes, if they gave you money and you took off to Cabo for 4 months, of course they're going to say something. But as long as you're a good partner and they make sure through multiple interviews that they're bringing on good partners, there's never really an issue. So I joined MB2 for a number of reasons. My age, I needed to do something. I wanted to secure my future and have stability in my practice. There was going to be no change of name. Nobody would know. I'd have complete autonomy. I knew I was getting involved with a great partner because one of my friends referred me and said they were great. And also I made a very lucrative deal. Our EBITDA grew dramatically, over 100% in the first year and a half of practice. Just through all the savings across the board, our EBITDA grew dramatically. So I never suffered financial loss from making less money. We always made the same money or more. So when my friend said to me, send your numbers to MB2, worst comes to worst, they say no, why not? I wasn't mentally ready to be a partner, but I sent my numbers, I listened to them, I disclosed my personal expenses, and I saw the process through to make an informed decision. Some quick parameters how to make that decision: practice size. Most DSOs want at least 1.2 million in revenue. They want 4 to 5 operatories. They want an associate in place. MB2 does not want a partner who wants to check out. Their average doctor partners in their 40s. They want longevity. And then, of course, does your EBITDA fit their parameters? Will the numbers work? The bottom line is if you qualify, you're crazy not to send your numbers, because if they'll accept you, you'll be financially set for the rest of your life. And the average doc is in their 40s. So with that, I'm going to thank all of you for listening tonight. I'm going to have Omar Jaroun from MB2 jump on here for a couple of minutes, but you can also scan this QR code to download MB2's 20 questions to ask before selling your practice. That's my email. That's my cell. You can text me. You can find me at Vino Dentino on Instagram if you want to ask me personal questions. And I want to thank all of you for joining me tonight. I want to touch base on some question and answers. So I have a question here. If you're still working in your practice, and why sell so early? So Bryce, that's a great question. So think about this. Let's say you've been fortunate and you built a lucrative practice and you're in your 40s and you don't want to deal with all the back office stuff and everything else. And MB2 comes along and they're offering you X millions of dollars for half your practice. We talked about saving early on in the webinar. The reality is that if you can advance your savings in your 40s and still own a piece of your business and still make a good amount of money, then I would say you're the fortunate ones. If I could have done it in my 40s, if my practices were big enough, I would have, and this was out there, I might have considered it. Because now you can get that money working for you in the markets and with a financial advisor, and it's all about then advancing your wealth while still maintaining your autonomy. So that's why the average doc is really in their 40s in MB2, because they understand it's still a partnership, and all they want to do is they want to advance wealth. They want to make wealth early so they can maybe retire earlier, so on and so forth. So I hope that answers your question, Bryce. So how does MB2 save me money day to day? So the answer is that it's the power of scale, right? So with 800 offices, everything becomes less expensive. So what you're paying for payroll expense with ADP or paychecks, my practice is paying 50% less. What you're paying for with your website hosting, I was paying $600 a month to host my website. I'm paying $75 a month with MB2 now. So when you start saving on every single aspect, what starts to happen is you're putting more money in your pocket. Now you say, well, I have a partner, MB2, correct. But if the savings really outweighs what MB2 is taking out, which was in my case, then I still got my money up front, got my stock up front, and saved money along the way in every aspect, and took more money home at the end of the week. So that's how MB2 begins to save money in practices. I mean, it's incredible. I thought I was good with what I was doing. Here's an example. I was paying $30,000 a year for my medical insurance. Through MB2, I'm paying $900 a month for my wife and I for high-end Blue Cross Blue Shield PPO. I can't compete with that. So that's the answer to that question. Well, if there are no more questions, I hope you enjoyed the webinar tonight. Feel free to reach out to Omar at MB2 or reach out to me, Instagram, Vino, V-I-N-E-O, Dentino, or email me, or you can call me, and I'd be happy to answer more. So thanks, everybody, and we hope you all have a great night.